Hey YouTube, it's Dimitri, and today we're going to discuss where is risk headed in 2017 and 2018. So I recently had a coffee with a few friends of mine from a consulting firm. This topic kind of came up on where is risk headed, and this kind of came up in the sense of like job-wise, where am I headed kind of question. But basically, let's dive in and talk about where is the industry headed as a whole. So now that DFAST and CCAR started up because of the 2007-2008 financial crisis, banks were putting a lot of money into hiring model developers, validators, implementers, and internal audit to meet DFAST and CCAR regulations. That was where the job market was when I graduated in 2013. I got lucky, I got a job, I worked hard, but I got into that risk management. The bank I worked for was 100% CCAR focused when I came in, so my job was implementing and developing models only for CCAR. On the consulting side of this, consultants were busy, consulting business was booming, there was a lot of work for consultants, so a lot of really small consulting firms popped up with very specialized employees, and they did very good work. They didn't need the big names, of BCG, KPMG, Oliver Wyman. They were good and they had enough work to go around for everybody, so it worked out well. However, as we sit here almost in September of 2017, the risk landscape has changed quite a bit. So Trump has become president. There's been a lot of talk about reducing CCAR and DFAST. So far, there hasn't seemed to be any movement on it. It's just a lot of discussion. However, even in 2017 here, coming into 2018, most banks have actually automated their systems. They're comfortable with whoever their regulators are, whether the Fed or the OCC. And so they've kind of came into this position where they've narrowed down the staff they need, they've automated systems, they've made it smooth, and so this CCAR DFAST kind of bubble, we've already peaked, and I think we're somewhere near the bottom of the trough, maybe mid-run down, but there's not a lot of jobs left on the CCAR side of it. So for those of you looking for risk and risk management, there are a couple different options which have always been viable. First off is credit risk. So credit risk is huge because literally every single institution that issues some sort of credit, so credit cards, mortgages, auto loans, personal loans, anything like that, they're going to build models for this credit risk that's going to be involved. It's a big industry. I'm currently working in it. It's exciting. There's fun parts about it. There's boring parts about it like any job. But that's where a lot of the risk is headed. Hedge funds is another great area to work in. Again, they're very, very competitive. Your job turnover rate might be a little higher than you expect or you would like. But again, that's going to be focused on the market risk. From DFAST and CCAR, the focus was all on credit, market, operational, and PPNR. PPNR and operational, the Fed's kind of downplayed, and many banks have kind of automated those either away to little minimal models, or it's just not really a crucial piece of the model anymore. Do I think this is good? Absolutely not. PPNR and operational risk play a crucial role in banking. I do wish banks would put more emphasis on risk management in general. Why do I say this? Because I come from a finance background and have the basic understanding that there's a risk and reward trade-off. And so the more risk you take, right, the better your rewards can be. However, also your risk is going up, the reward's going up. There's also a massive possibility of failure. And so I think banks aren't putting enough emphasis on this. Just my opinion in general, nothing specific, but I just think there needs to be more emphasis on risk and implementing that into the business model. So where is risk headed in 2017, 2018? Like I said, it's in the traditional fields, guys. So you need to go into something like credit risk. CECL, which is part of the FASB new regulations, which is CECL is CECL, which is current expected credit loss. That's a big move banks are preparing for, getting ready for, already have implementations in place. So again, it's credit risk and market risk are kind of the two big areas. Credit risk, I think there's a lot more jobs. Market risk, there's still a market there. But again, you need to go back to traditional banking because a lot of the CCAR and DFAST risk management jobs have dried up. So that's kind of my opinion. I'd love to see what you guys have to say, especially if you work in risk. If you work in something else besides like a big institutionalized bank, so you work in like a hedge fund, for example, or wealth management, what do you guys see the trend in risk management in your industries and your businesses? Leave a comment below. If If you like this content, don't forget to share and like and subscribe. It really helps out my channel and continues allowing me to make videos like this. Thanks guys, and as always, until next time. Thanks for watching my video. If you find it helpful, please like, share, and subscribe.